Gold just printed a number that makes Wall Street CES normal narrative impossible to maintain, and the price you're staring at is the least important part of what S happening, because the headline is screaming spot, but the spread is whispering something far more dangerous for anyone who is still positioned like this is a tame, well-behaved market. And that's where the real pressure starts. Later in this video, I'm going to give you the one level that matters for the next 1 to 2 weeks, what confirms the squeeze path, what invalidates it, and why the calendar is about to force decisions from funds that Don T get to wait and see. First, anchor the tape so we don't drift into vibes. If you've been watching gold for the last year, you felt it. The market doesn't move like a sleepy inflation hedge anymore. It moves like a currency that just got promoted back into the main cast. One screen might still be replaying the $2,175 spot. Milestone like that was the peak moment, while another screen is showing you prints that make that number look like ancient history. That mismatch is not a mistake. It's the clue. Different feeds, different contracts, different currency translations, different timing, yet the same underlying fact. The market crossed a line, held it, and forced every risk desk to update the rules. And when the rules update, the flow updates. That's the part people miss. The reason the 2975 headline mattered is not because it was a magic number. It mattered because it was the moment the market stopped behaving politely around psychological levels. It didn't just tap it and fade. It pushed, consolidated, and kept going. And once a market proves it can live above a level the crowd thought was too high, it stops being a debate about value and becomes a problem of exposure. Who is underweight? Who is short? Who sold calls? Who promised clients diversification, but doesn't actually own the thing that diversifies? But that's not even the best part. Here is the conflict you need to hold in your mind. The public narrative wants gold to be explainable. A tidy story. Inflation here, rates there, geopolitics over there. A story you can compress into a headline and move on. But gold doesn't care about tidy stories when the plumbing gets stressed. It cares about financing. It cares about deliverability. It cares about who needs what, when, and under what terms. And the market structure will always tell you that story before the headline does. Because spreads don't do opinions. Spreads do constraints. Now, let yes talk about the thing everyone keeps tripping over. Morgan Stanley turns more openly bullish, and Wells Fargo seems quiet. People read that like a soap opera, like someone's right and someone's wrong. That's a retail way of reading institutional behavior. Big banks aren't tweeting emotions. They're managing reputational risk, client positioning, and the reality that when a trade gets crowded, language matters. One shop can go loud because their client base needs permission to rotate. Another can stay measured because their client base already has exposure and doesn't need to be stirred into chasing. Silence doesn't mean they don't see it. Silence can mean they don't want to be the match in a room full of fumes. And that's where you should get very interested. Because when an institution that has been cautious becomes more constructive, it's usually not because they suddenly believe in gold. It's because the probability-weighted path of macro, flows, and stress just crossed a threshold. That's math, not mood. And if you're watching this space, retail investor, macro watcher, metals crowd, institution skeptic, you know the real game is not what do they say, it's what do they have to do. So what do they have to do right now? They have to manage a market that has learned it can levitate even when the traditional excuses Don T line up cleanly. Gold can rally with a strong dollar for stretches. Gold can rally while yields jiggle. Gold can rally because the buyer isn't T your neighbor buying coins. It is a reserve manager shifting composition, a fund reallocating risk, or an institution that suddenly wants fewer promises and more collateral. And when those buyers show up, they don't negotiate with your chart patterns. They execute. But I promised you the hidden detail, so here it is. Cleanly, without the cartoon conspiracy tone. The tightness that matters is not how much gold exists. It's how much is deliverable, movable, and financeable at the exact moment the calendar compresses everyone's options. The world can have plenty of gold in aggregate, while the market still experiences scarcity in the specific form that settles obligations. That's the difference between metal exists and metal clears. And if you've never watched that distinction bend price discovery, you're about to. Gold is a hybrid market. It trades like a currency, because it's global and sensitive to policy credibility, but it also behaves like a physical commodity because there is a real object at the end of the chain. That hybrid nature is why the paper market can look calm while the physical market gets tense, or vice versa. Futures, forwards, OTC swaps, these are instruments that can express exposure without immediate physical movement. Most days that's efficient. It's how liquidity exists. But when the system hits a window where certain participants need deliverable exposure or need to hedge deliverable exposure, the difference between paper claims and physical availability becomes the lever that moves everything. And that lever It doesn't announce itself with a press release. It shows up in the curve. It shows up in lease dynamics. It shows up in spreads and the way spot behaves relative to forwards. The price is loud, but the curve is honest. Let's make the mechanism simple. In a normal carrying market, holding physical gold has costs: storage, insurance, financing. That's why the forward price is often above spot. That's contango. It's the market saying, if you want the thing later, it costs more because time has a cost. But when that structure compresses, when the premium for time shrinks or flips, something is changing. It means the market is putting a higher value on having the metal now, not later. That can happen for several reasons: a scramble for immediate inventory, a financing squeeze, a short that needs coverage, or a shift in hedging demand that hits the front end of the curve. And when that happens, it forces behavior. Dealers adjust hedges, arbitrageurs step in, inventory gets pulled, the flow becomes self-reinforcing. And that's where the real pressure starts. Now fold in the other mechanism that turns normal rallies into vertical candles: options reflexivity. You don't have to be an options nerd to understand it. Here's the core. When a lot of options are outstanding around certain strikes, the dealers who sold those options often hedge their exposure dynamically. If price moves toward the strikes, their hedge needs change. Sometimes they have to buy as price rises to stay hedged. That buying can push price higher, which forces more hedging, which pushes price higher again. It's not a conspiracy. It's a feedback loop. It's a mechanical chain reaction. And in thin liquidity, that feedback loop doesn't need a huge spark. It just needs the right positioning at the right time. Because if one level breaks, the math changes. So what's the why now trigger? It's not just gold is bullish. It's the calendar corridor we're in. Early January is notorious for two things: fresh positioning and thin liquidity. Funds re-risk, rebalance, and reset. Dealers reprice. Macro data hits when positioning is still in motion. And then you run straight into a cluster of deadlines: key inflation prints, a central bank meeting, and the options and futures calendar that decides who can roll calmly and who has to make a decision. When you combine thin liquidity with hard dates, you get discontinuous moves. That means gaps. That means air pockets. That means a market that can whip around violently even if the underlying thesis is correct. That's not a bug. That's the environment. And if you don't respect that, the market will teach you respect the expensive way. Now let's build a proof stack, because one argument is never enough in a market like this. Here are multiple layers that all point in the same direction, and I'll translate each one into so what terms. Proof point one is the simple one. Everyone sees, but few interpret correctly: the chart structure. When a market makes a new high after a historic run and refuses to give it back, that's not just bullish. It's a signal that supply at those levels is being absorbed. Absorption is not a motivational quote. It's order flow. If sellers are throwing inventory at a level and price doesn't collapse, it means the other side is bigger, more patient, or more compelled. And compelled buying is the kind that doesn't wait for your perfect entry. That's why the tape feels rude. That's also why you should stop thinking in one-dimensional terms like overbought. Overbought is not a timing tool in a regime shift. It's a warning that volatility is coming. Proof point two is institutional language and target behavior. When a large bank shifts tone more bullish, it tends to coincide with an internal recognition that macro inputs have changed. Maybe they see lower forward real rates. Maybe they see stronger official sector demand. Maybe they see that the cost of being underweight is rising because clients are asking for exposure and the bank wants to be positioned as helpful, not late. The point isn't that one bank's forecast is a crystal ball. The point is that institutional behavior often lags structure, then accelerates once it can be justified. That acceleration is what turns a trend into a chase. And once that chase begins, the next detail is what flips the whole setup. The chase forces derivatives desks to hedge differently, which can amplify the move. Proof point three is the reality of reserve and sovereign behavior. Central bank buying, when it's in play, is not the same as ETF hot money. It doesn't flinch on a red day. It's not looking at your RSI. It's making a multi-year decision about policy credibility, sanctions risk, and portfolio composition. When that bid is present, dips can be shallower and rebounds can be faster, because the marginal buyer isn't emotional. The marginal buyer is strategic. And when strategic buying overlaps with speculative momentum, the market becomes top-heavy in a good way, until it becomes top-heavy in a dangerous way. Because one side eventually runs out of patience, but that's not the part that matters most right now. Proof point four is ETF and fund flow behavior. ETFs are a pipeline that turns sentiment into mechanical demand. When flows turn positive in size, they're not asking for a better price. They're buying because their mandate is to track exposure. That creates price-insensitive demand. If flows accelerate while dealer positioning is sensitive, you can get a reflexive loop where price goes up because flows go up, and flows go up because price went up. That's reflexivity. It feels like magic. It's not magic. It's a feedback system. And in a market with limited immediate liquidity, it shows up as sudden vertical moves that make people say, this can't be real. But it can. That's why it's dangerous. Proof point 5 is the curve and the financing story. You don't need exact inventory numbers to understand the principle. If the front end of the market tightens relative to the back end, the market is signaling a preference for immediacy. That can happen even if total above ground stock is huge, because the relevant stock is the stock that can be delivered and financed at a given moment. In other words, scarcity is contextual, and when scarcity becomes contextual, price discovery gets jumpy. Arbitrageurs try to smooth it out, but arbitrage itself requires balance sheet, and balance sheet has a cost. In stressed windows, that cost rises. When the cost rises, arbitrage weakens. When arbitrage weakens, spreads can widen. When spreads widen, price can do things that look wrong on a screen, but are perfectly rational in the plumbing. And that's where the real pressure starts. Proof point 6 is cross-market and cross-currency behavior. If gold is only rallying in dollars, you can tell yourself a story that it's just a dollar story. But when gold is strong across currencies, the story shifts from FX noise to global repricing. When it's a global repricing, it asks less about your local rate narrative and more about the role gold plays in a world where trust is being repriced. You don't have to believe in doom, you just have to notice that portfolios are being built with more respect for tail risk. And gold is a tail risk asset that trades like money. That's not romantic. That's functional. Now, let's address the thing that makes people roll their eyes. Manipulation. Here's how adults talk about it. Markets have incentives. Participants manage risk. Large players sometimes lean on price to manage exposure, improve execution, or reduce slippage. That doesn't require a villain monologue. It requires a balance sheet and a mandate. In metals especially, you often see tension between paper liquidity and physical constraints. Sometimes the paper market can push price around intraday. Sometimes physical flows set the floor. Sometimes options positioning creates a magnetic zone where price keeps snapping back because hedging flows dominate. These are structural effects. If you want to stay credible, you don't claim certainty. You focus on mechanics because mechanics are observable and mechanics have consequences. So why is Wells Fargo silent while Morgan Stanley appears more openly constructive? Because in a crowded, emotionally charged market, the loudest voice often becomes the scapegoat when volatility hits. Some institutions prefer to guide quietly. Publish ranges, suggest allocations, frame gold as insurance, then let clients decide. Others go louder when they believe the cost of underexposure is now bigger than the cost of reputational risk. Both approaches can reflect the same internal conclusion. The regime is shifting. The language differs because the audience differs. That's all. But the behavior that matters is the same. Allocations creep higher, hedges shift, and the marginal buyer becomes less sensitive to price. The market doesn't need universal agreement. It needs incremental demand in a market with constrained immediacy. And it has that. Now we need to talk about the psychological trap this environment sets for you. Because if you don't understand the trap, you become the exit liquidity for someone who does. The trap is simple. Volatility will be used against you. When price rips, it will feel like you missed it and need to chase. When price dumps, it will feel like the thesis is dead and you need to panic. Both feelings are useful to institutions. They need you to buy tops and sell bottoms because it improves their execution. Not because they're evil, because it's how liquidity works. The market is a machine that turns your emotional urgency into someone else's measured opportunity. That's the psychology shield you need. Separate trend signals from noise. Trend signal is structure. Higher highs that hold, dips that are bought quickly, strength across currencies, a curve that refuses to relax, and institutional behavior that shifts from ignore to manage. Noise is the daily headline roulette. One official says a thing, one data print surprises, one risk-off day hits, and price whips. In a bull regime, noise is violent. That's not a contradiction. That's the definition. The market can be bullish and still punish you. In fact, bull regimes often punish harder because they attract leverage. Leverage creates forced selling. Forced selling creates sudden drops. Those drops are what shake people out right before the next leg. The trick isn't predicting every candle. The trick is knowing what would actually invalidate the setup. So let's make this practical. Over the next 1 to 2 weeks, you should expect two things to overlap: macro catalysts and mechanical catalysts. Macro catalysts are the obvious ones: inflation data, policy commentary, and risk sentiment. Mechanical catalysts are the ones people ignore until they get slapped by them. Options expiries, month-end rebalancing, and thin liquidity windows that turn ordinary flows into oversized moves. The calendar is the catalyst, and that means you should think in levels and behaviors, not in stories. Here's what I mean. Identify a zone that, if defended, tells you the bull structure remains intact. Identify a zone that, if reclaimed after a pullback, signals continuation. Identify a failure point that, if lost decisively, tells you the market is entering a deeper reset. I'm not going to insult you with fake precision. This is about a framework you can actually use. In the current environment, the first anchor is the most recent swing low zone, the area where the last meaningful pullback found buyers. If gold pulls back into that region and the selling slows, spreads stabilize, and the market snaps back quickly, that's controlled pullback behavior. That's the base case bull market action. It looks scary, then it doesn't break. The second anchor is the recent consolidation band near the highs. Call it the area where price has been battling between profit takers and late buyers. If gold breaks above that band and holds, meaning it doesn't immediately fade back under it, that is your continuation signal. That's when the options and dealer mechanics can light up again, because dealers who were comfortable become uncomfortable, and discomfort creates hedging flow. And the third anchor is your invalidation zone. If price loses the prior swing structure and fails to reclaim it quickly, that's when you stop acting like every dip is a gift and start respecting that the market might need time. Time is expensive if you're leveraged. Time is survivable if you're positioned like a professional. Now, let's translate those anchors into what you watch day to day. You watch how price behaves around those zones, but you also watch the truth tellers, the curve, the spreads, the reaction to data, and the speed of dips. If price dips and the curve stays tight, that suggests physical stock financing tightness remains. If price dips and the curve relaxes while the dollar surges and real yields bounce, that suggests the move is pausing because macro is leaning against it. Those are different dips. One is a reload, one is a reset. And you don't want to confuse them because the next detail is what flips the whole setup. Also, watch the way rallies happen. If rallies are slow and grindy, that's one kind of bull. If rallies are sudden, vertical, and gappy, that's often options and liquidity. Sudden vertical rallies can be followed by sharp pullbacks, even if the trend continues. That's why you must stop thinking, if I'm right, it should go up smoothly. No, if you're right in a reflexive market, it can still go down hard first. That doesn't mean you're wrong. It means you're in a market that punishes certainty. Now let's do the two scenario lens, because it keeps you honest and keeps you from turning into a preacher. Scenario one is the controlled pullback and retest. In this path, gold pulls back on a macro scare. Maybe inflation prints a touch hot. Maybe the dollar bounces. Maybe rates pop intraday. You get a nasty red candle. The commentators cheer. See? It was a bubble. Then the selling dries up. The market holds the key zone. Dips are bought. Within days, price works back into the upper band. In this scenario, the confirmation is not a perfect V-shape. The confirmation is behavior. Lower volume on the sell, faster reclaim, tighter spreads, and the refusal to break structure. If you see that, the trend remains the dominant force and the next upside attempt becomes a matter of time, not belief. Scenario 2 is the continuation squeeze with gap risk. In this path, gold doesn't give you a polite pullback. It chops briefly, then rips through the upper band and holds. The move feels unfair. It's fast, it's thin, it's full of micro gaps. This is when Morgan Stanley reversed bullish type headlines start feeling like gasoline because retail hears it as permission, while institutions hear it as consensus is moving, reposition now. Dealers who were short gamma have to hedge into strength. Shorts cover, underweight funds chase, the move accelerates. In this scenario, the confirmation is a hold above the breakout zone into the close, especially into a weekend or a data event, because that S when risk managers can T ignore it. If it holds, you get the squeeze dynamics. If it fails and snaps back under, it's a trap. And traps are violent, because if one level breaks, the math changes. What weakens the bull case in the near term? Two main categories. First, a genuine policy shock that shifts the rate path more hawkish than the market has priced. If real yields climb meaningfully and the dollar catches a sustained bid, that can compress gold temporarily. The second is liquidation, not disbelief liquidation. In a market that has run hard, some participants are leveraged. If they're forced to reduce, they sell what they can, not what they want. That creates fast drops. Those drops can temporarily override fundamentals. That's why you need to watch structure, not emotion. If a liquidation drop breaks the key zone and fails to reclaim quickly, you respect that the market might be entering a longer digestion. You don't marry a candle. You don't divorce a thesis on one headline. You manage risk like someone who wants to stay in the game. Now let's bring it back to the title's tension. Wells Fargo silent, Morgan Stanley bullish. The real takeaway isn't who is louder. The real takeaway is that the institutional conversation has shifted from, is gold relevant? To, how do we position without getting embarrassed by volatility? That shift is the tell, because institutions don't move when they feel comfortable. They move when discomfort becomes risk, and right now, being underexposed is starting to feel like risk. That's why you're seeing tone changes. That is why you're seeing the market behave like it has a floor under it, even on ugly days. And that's why you must focus on the hidden detail. Deliverable movable, financeable metal in a calendar squeeze is what turns bullish into discontinuous. So what do you do with this as a viewer who demands logic and hates being sold hype? You build a simple checklist for the next 1 to 2 weeks. 1. Does gold defend the recent swing low zone on a pullback, or does it slice through and fail to reclaim? 2. Does it reclaim the upper band quickly after weakness, or does it stall below and grind lower? 3. Do rallies hold into the close, or do they fade hard, suggesting supply is still dominant near highs? 4. Do you see the telltale signs of reflexivity? Fast upside, thin liquidity, outsized intraday moves around known option zones? 5. Do macro catalysts create temporary noise, or do they change the regime by altering the market's expectations for real rates and liquidity? And here's the part that will save you money. You do not let the market trick you into all or nothing thinking. You don't have to be all in to be right. You don't have to be all out to be safe. The market wants you binary because binary people are easy to harvest. It wants you euphoric on green days and hopeless on red days. Your advantage is being boring when the market gets dramatic. You respect that price can whip around violently even if the thesis is correct. You distinguish trend from noise. You keep a 2-scenario map. That S, how you keep your trust in your process instead of outsourcing it to whatever the last candle felt like. Now, one more thing about spreads, because this is the part that separates headline watchers from structure watchers. When you hear spot, ask yourself, what's happening between spot and forwards? What's happening in the cost of carry? What's happening in the ease of moving metal through the system? Because those are the stress gauges. The crowd will argue about whether gold is too high. The professionals will ask whether the market is pricing immediacy differently than it did a month ago. If the answer is yes, you're not looking at a normal rally. You're looking at a market that is repricing constraints. And markets repricing constraints don't move politely. So here's the concrete payoff I promised. The next 1 to 2 weeks will likely be decided not by a single headline, but by whether gold can either hold its key support zone on a pullback or break and hold above its recent high band into the close. If it holds support and reclaims quickly, the base case trend continues, with dips being opportunities for the patient and traps for the emotional. If it breaks and holds above resistance, you're in squeeze territory, where upside can extend faster than most people can mentally process. And the risk becomes gap risk, moves that happen when you're asleep or when liquidity is thin. If it fails both, breaks support and can't reclaim, then respect the possibility of a deeper reset, where the market still may be bullish on a longer horizon, but the near-term trade becomes about survival, not prediction. And if you're wondering why this matters beyond a chart, remember what gold is expressing in this regime. It ain't a referendum on confidence in the system S's promises. Sometimes that referendum is subtle, sometimes it's loud. Right now it's getting loud. Not because the world ends tomorrow, but because portfolios are being built with less faith in smooth outcomes. That's why this market has a different energy. That's why institutions adjust. That's why the curve matters. That's why the calendar matters. And that's why you should be watching behavior, not slogans. If you've made it this far, you're not here for dopamine trades. You're here to read the market like a machine, not like a mood. Stay in that identity. Keep your checklist. Respect the 2 scenarios. Don't let volatility steal your thesis or your discipline. And if you want to be part of a community that treats metals and macro like a serious craft, where we talk mechanisms, invalidations, and what to watch next week instead of chasing whatever S trending, then you already know what to do.